Hey, what's going on, guys? Welcome back to my channel. This is Blood Phantom 81. I hope you're having an awesome day so far. So in this video, I want to fulfill a subscriber request. So this one comes from Market Scraper. Market Scraper is a friend of mine. He's a friend of the channel. He also has his own channel where he talks about SPACs and technical analysis and Tesla and other trending topics. Really smart guy, really funny guy. I'm a big Market Scraper fan myself. And so what his comment was, he wanted more sector analysis when I see opportunities, especially like I did with REITs. So the video that he's talking about is this video right here where I did a REIT market overview as well as some case studies. So I posted this on December 14th, 2019. You guys can check it out if you'd like. I'll share it in the description down below. And you can also see Market Scraper's comment right here. So what I'm going to talk about first is just do an overview of the financial markets. So we're going to just take a long-term perspective at what's been going on over the past decade or so. We're also going to take a look at what I'm buying, if anything at all. The case study will be focused on banks towards the end, but I'll be talking about all kinds of stocks. So let's go ahead and jump right into it. Cool. So financials right now, in our current market environment, if you're not consumer discretionary or tech, chances are you may not be doing so well. I guess I can include healthcare in that discussion as well. But there's a few sectors in the S&P 500 that have sort of been demoted to be value sectors, which is something I've talked about on my channel before. But obviously, it's very evident with financials and industrials, especially. And so, yeah, basically, tech has been leading the way. But part of what makes this market rally so relentless is that on the days where tech sort of gets tired and pulls back a little bit, you have financials and industrials and like transports, for example, actually doing somewhat well, even small caps. And the same can be said over the past 3 weeks for financials. In fact, on Friday, XLF, which is a financials ETF, I believe did about 2%, while XLK, which is the technology ETF, was down like 1%. And so we're starting to see that discrepancy a little bit more. With that being said, a lot of these financial stocks, especially big banks, are still well below their all-time highs. And so we're going to take a look at that. The other thing I will say is that just because a stock is well below its all-time high does not really make it a value, in the sense that there's a difference between something being cheap and something being a value. I know a lot of investors, like firsthand, that will only feel comfortable investing in something that's well below the all-time highs. But honestly, sometimes a stock is well below its all-time highs for a reason. And again, I keep picking on these big bank stocks. I don't think all the bank stocks are bad, but certainly some of them I would think twice before getting into them. And we're actually going to do the case study towards the end of the video. But yeah, like I said, so generally the characteristics of financials is basically since the '08 recession, you've had like really strong moves and then periods of consolidation, and then you've had a breakout and then a retest and then a really strong move, and then period of consolidation and then a breakout, retest, and then really strong move, and then period of consolidation and then breakout, retest, really strong move. Cool. And then but the behavior recently, as I mentioned, has sort of been kind of different. And then the second thing I want to point out from a price perspective is that um, we've just barely made an all-time high in early 2020 relative to the '08 high. And that's probably one of the only sectors, as far as I know, that has that kind of characteristic. You can go ahead and take a look at any other sector. Let's just take a look at something like healthcare, for example. I'm just picking something randomly. And healthcare, you can obviously see that we're well above the '08 highs and obviously well below the '08 lows. Even something that's supposed to be more defensive, like utilities, we can take a look at that as well and see that we are once again well above the '08 highs and well above the '08 lows. So the reason for this, in my opinion, is something that we should look no further than Bank of America, Citigroup, and some of these other large constituents of XLF. So Bank of America, as you guys can see, well below the '08 lows, and actually well below its 2020 highs. Citigroup is another stock, and honestly, this almost looks kind of like manufactured. I don't even know what happened here. This looks like the Roadrunner and Coyote or something. Like it just got whacked with a hammer or something. And yeah, it doesn't even look real, right? And then our friends over at Wells Fargo. So obviously this is the '08 highs. These are the '08 lows. Now we're actually in between the '08 highs and the '08 lows. So something's been going on with these financial stocks. And so the stocks that I mentioned have traditionally been big constituents of XLF, but I think there's some, let's say, higher quality companies that can also be found within XLF. But the other thing is, I think there's some other companies that you may have to think twice, right? Because something can be involved in financials, but still not be considered a financial company per se. But I think those are also still valuable. So we're going to dissect all that. For the first stock, I want to take a look at a company called Cincinnati Financial. So this is Cincinnati Financial over the long run. I would say they were pretty overvalued here back in late 2019, but they've gone to a better valuation. I would say like at best, this is a discount. At worst, this is fair valuation. So as my first disclaimer, I want to say that I'm actually buying Cincinnati Financial right now. Okay, so what is Cincinnati Financial? So they are a company. I'll start off with the facts first. They've been increasing dividend yield for a remarkable 59 years in a row, making them a not only dividend aristocrat but also a dividend king. What they are is basically an insurance company, and they basically do it all. So they were founded in 1950. They offer business, home, auto insurance, as well as other financial products, including life insurance, annuities, and property and casualty insurance. So on the insurance space, that's basically everything you would expect. But they also cover annuities, which is somewhat of an investment, or just like I would say, like fixed income type product. And so that investment and income type products usually go hand in hand. So it's nice to see that they're so comprehensive with their products. So they're basically across 44 different states, and they're actually doing pretty well in most of the states in terms of market share as well. And so now let's talk about their business model and what really makes them stick out. So it's actually right here. So Cincinnati Financial is willing to write lower margin policies, meaning that they're able to sell products for cheaper. And so the way that they earn their profit is by selling high volume of their product and taking market share. So that's basically, if you sell a cheaper product, you're able to take more market share and you're able to sell more of that product. And so this is actually really cool. So in addition to being an insurance company, and so the way insurance companies work is they calculate, how much of a risk a person would be, and based on that, they give them like a certain fee or like policy amount. And so the idea is over the long run, insurance companies actually make a lot of money because even though like if something goes bad, they have to pay a lot of money. They have expected value formulas, which I've talked about in my channel, to determine, every time they make a policy, they want to make a profit from a probability standpoint, right? From a statistics standpoint. And so insurance companies also have floats, meaning like a big pile of cash in case something goes wrong. What Cincinnati Financial does is they actually invest their float into stocks. So honestly, that's really cool, and it could be seen as a double-edged sword because they are dependent on how the stock market's doing. But the fact is, like making the most out of the resources you have, and just being like ambitious in that sense is something I really, really like about Cincinnati Financial. So Cincinnati is a company to me that has shown like decades of just superior and smart management. And so that's why I'm okay with all the uncertainties that come with insurance companies. For example, there's sort of like a lot of insurance companies that are up and coming right now, and there isn't like that high of a barrier to entry, surprisingly. And then, like if we take a look at the recession, for example, the '08 recession, they did see EPS declines between '08 and '09. However, even during those recessions, they remained profitable and they were able to not only maintain their dividend, but actually increase their dividends. The next two companies I want to give a shout out to, and one I'll talk about a little bit more, are not showing those sort of deep discounts that I've been talking about on this channel. But when I'm thinking about long-term investments, that's not really like my first thought is where are we relative to their all-time high. I always think about like what's the best company right now because I want to basically have my investments on autopilot when I'm talking about a decade or 2 decades down the road. And so the next company I want to give a shout out to very quickly is SPGI. So they are pretty well above their 2020 highs. That's okay. I'm still investing in them right now as I make this video. The next company I do want to talk about is T. Rowe Price. Okay, so T. Rowe Price Group is also a dividend aristocrat. They've been increasing their dividends for 33 years in a row, including a 8.6% hike last year. And so they have about a 2.5% dividend yield at the moment, which is actually pretty solid. And yeah, so They've been around for a while. They're one of the largest financial service providers in the country. My company, my ex company, actually used T. Rowe Price Group for their 401k plans, and that's kind of the thing that they do. It's asset management and retirement planning and advisory services and other just managed accounts. As you guys can see, they are pretty diverse in terms of the types of products that they offer. So there's multi-asset, there's U.S. equity, which is basically stocks, and there's a whole bunch of different fixed income products. So they do offer a variety of products, as well as their client types being pretty diverse. So they do sell products to global institutional investors, as well as U.S. individual investors, that's people like you and me, as well as other types of clients, as you guys can see. Now, keep in mind when we're talking about asset management, there is like a few headwinds that we have to address. That's number one. A lot of companies are starting to lower their fees in the sense that like it's becoming cheaper and cheaper to invest. So we don't necessarily have to go through like a middleman of some sort to actually invest our money. The other thing is that when it comes to asset management, it's basically a tough moat. I would say it's tough to build a moat because you basically have to go off of either brand recognition or performance. And like yeah, sure, you can build up a good reputation, but like it's just kind of a vicious sort of market. However, the key selling points of T. Rowe Price, in my opinion, is their ability to bring in new money. They're the type of company that actually brings in a few $1 billion every single quarter. They've been doing that for a while. They also have about 1.13 trillion in assets under management, which is a massive amount of money. They're generating a whole bunch of money off the money they manage. It's funny because their money literally makes them money, obviously, as we know how that works. The other thing is just brand recognition and excellence in terms of just management. So they've built a strong reputation through strong mutual fund performance. Over the past 10 years, over half the company's mutual funds place in the top quartile of performance amongst their peer group. They consider their employees to be one of their most valuable assets, as most companies should. As you guys can see, they're constantly growing their offices and their employee headcount. So I personally think there's going to be a demand for these sort of fixed income products and advisory services and just money management in general for a long time to come. And obviously, one of the great things about just dividend aristocrats in general is if for any reason you feel like if the dividend is cut, for example, that's a really good reason to get out of an investment. So that's just such an easy metric to go by. Basically, it's almost like you're bowling with gutters on either side, right? Like you're always going to get something for the most part, and it's very easy to tell when to move on from there. And so that's actually a perfect segue into my next stock that I'm talking about, and this is Franklin Resources. So I do want to give a big disclaimer is that if there was a company that would cut their yields out of the ones that I described, it might be this one. With that being said, they are also a dividend aristocrat. They've been increasing their dividends for over 30 years. Franklin is also an asset management company. Let's just take a look at their history for a second. So they're actually near their 08, 09 lows. And that's like a clear discount, right? I mean, it's either cheap or value. So which one is it? Are they showing a good buying opportunity, or is it something that we should try to stay away from? So full disclaimer, I'm actually long Franklin Resources. So they're paying out about a 5% dividend yield right now, which is actually massive. Their dividend growth is somewhat decent, right? It's not the best, but it's definitely not the worst. And yeah, like I mentioned, they are an asset management company. Because I already talked about asset management with T. Rowe Price, I won't get into it that much. But what separates this company from others, obviously the amazing track record of dividend growth. But the other thing is their ability to grow by acquisition, which is something that I really find just a really enticing investment. I like companies that are willing to grow regardless of the means, whether it's inorganically or organically. And so the most recent acquisition of Franklin Resources actually came pretty recently. So they recently acquired another financial asset management company called Legg Mason, which made a 1.5 trillion assets under management global investment super company. And so basically what this does is this eliminates a competition. It also sort of widens their moat, and you get the best of both worlds in terms of experience with both companies. Obviously they can now learn from each other, but it also puts them now in the same tier as other very large financial institutions, such as JP Morgan's asset management company, as well as PIMCO, which actually has a lot of ETFs that we like to talk about. And so just to sort of close the loop on Franklin Resources, so they are, I think I misspoke earlier. I said they're sporting a 5% dividend yield. It's actually close to 5%. They actually went up in share value not too long ago. I think it may have to do with the Legg Mason acquisition. Payout ratio is solid. 5-year growth rate is amazing. I don't think they're going to be able to keep this up for a while, but that's actually pretty solid. As I said, they're not the worst when it comes to dividend increases, and then dividend growth is 40 years, which is also very amazing. So I'm buying this one. I see it as a very good risk to reward setup. And the last thing I want to talk about before we get into the case study is basically a point that I touched upon earlier, which is looking for financial stocks outside of the traditional financial realm. And that basically comes with payment processing companies and credit card companies such as Visa, Mastercard, and Square. They are embedded into technology so much that they're not even seen as traditionally financial companies, but in my opinion, that's basically what they are, right? So they don't need that much introduction, so I won't get into them that much. But Visa, MasterCard, I think are solid buys right now. Obviously, we can see with Visa, they're consolidating in this range, which is something that stocks tend to do after big moves up. So I'm really liking Visa. And then MasterCard is also showing the same thing. Square, I would say, is pretty extended, but I'm buying this one for like a long-term portfolio in small increments, and we'll definitely be getting in on any other dips from here on out. Okay, cool. So now let's get into the case study. So I basically want to talk about the three big banks right now, which are Bank of America, Wells Fargo, and Chase, because I think they hold the biggest amount of weight in this financial narrative, so to speak. So they're clearly like the three largest banks in the U.S. Maybe I could be wrong in terms of what sectors you're looking at or like classes of banking we're talking about, but generally these are the big three, right? And so the sort of narrative out there is that JPM Chase is the leading bank and Wells Fargo is the worst bank. And so in this case study, we're going to evaluate whether or not that's true. We're going to look at different metrics. And so the first thing I want to talk about is expense management. So there's a ratio called the bank efficiency ratio, which is a ratio for banks. We can use it to compare it across banks and do like an apples to apples comparison. So basically what this talks about is how well banks are at managing expenses. And so Bank of America, as we can see right here, they're hovering around 59% and 57%. Oh, and by the way, the lower number, the better. So let's just take a look at Q1 2020 actually. So it's clear that Wells Fargo is the worst in this category. So they have the highest bank efficiency ratio, meaning they're the least efficient in terms of managing expenses, where Chase and Bank of America are like number one and number two, and you will see that sort of trend throughout the rest of this case study as well. Okay, so the next metric I want to take a look at is bank growth. So this is just like raw growth in terms of money coming into the company, not really talking about expenses. I just want to take a look at the different classes of banking that these banks actually have. So the first one is bank growth. So once again, Wells Fargo has the worst bank growth year over year. This is between this year and last year, whereas Chase is number one. In terms of deposit growth, so this is just bank deposits, JP Morgan is the clear winner here, where Wells Fargo is once again number three. And then in terms of year over year revenue growth, so obviously with everything that happened this year, a lot of really big banks struggled, and I think they will continue to struggle for the next couple quarters actually. But considering that Wells Fargo was still the worst, like by a pretty wide margin in terms of revenue growth, and Chase and Bank of America are once again neck and neck. With that being said, I think there may not be like a huge difference between JPM and Bank of America, but if there was a bank that I would have to invest in, JPM is the clear winner. And so I want to wrap it up by basically going over a quote that someone named Eric Compton, who's a that's the coolest name I've ever heard of actually. So he's a CFA. I think he summarized the points quite well. So he said JP Morgan is arguably the most dominant bank in the United States, with leading investment bank, commercial bank, credit card, retail bank, and asset and wealth management franchises. JP Morgan is truly a force to be reckoned with. The bank's combination of scale, diversification, and sound risk management seems like a simple path to competitive advantage, but few other firms have been able to execute a similar strategy. Even the best managed banks are not immune to the occasional stumble, but JP Morgan has managed to seemingly put all the pieces together in a more cohesive and less error-prone way than peers. I'll just read the next few sentences and then we can sort of wrap up here. So, JP Morgan now benefits from a nearly unrivaled combination of scale and scope within the United States. JP Morgan has become the largest bank in the country by assets and deposits. Within payments, depending on the metric, JP Morgan is generally the largest credit card issuer in the US and the second largest acquirer by purchase volume. So yeah, I think in terms of big banks, there's sort of this idea of too big to fail, which is sort of generally true, right? I mean, Wells Fargo, Bank of America, and Chase, despite all their headwinds right now, they're probably going to be around for a while. But I see that as a justification for an investment too often, which is like, yeah, they're going to be around for the next 10, 15 years, right? They're going to be around for the next 20 years. Like, that to me is not good enough justification, especially when there's other companies that are just growing and innovating and being strategic with their management and just have a brighter outlook, I would say. That's kind of the point I want to get across. And the other thing is know why you're investing in something. So these companies should be giving you something, right? Like, you have to be ruthless with your investments and ask the question, what is this company going to give me? Because let's take a look at the different ways to invest, for example. Like, you might be thinking about dividend income. Well, these big bank stocks have shown that they will most likely cut their yields in terms of a recession, right? Because they're pretty massive, they have a lot of overhead, they're heavy, they're not flexible, they're not innovating. And so when the economy is down, I think it's possible that they will also cut their dividends. So, think about that for a second. And then the other thing is, in terms of capital appreciation, once again, we talked about it, they're not really innovating or growing that quickly. So that might not be there either. And the last thing is sort of like, yes, there's a argument to be made about like them being a core piece of the American economy, which is true. In that case, though, like, think about index fund investing, for example. Like, I'd rather invest in some kind of ETF that holds these bank stocks than hold like just Wells Fargo or like just Bank of America, for example. So yeah, like, I think, just to wrap things up, like, I actually think they're good. Some of them are good values. Some of these bank stocks. I didn't even talk about all the banks, right? There's other banks like Goldman Sachs and Morgan Stanley. I'm just talking about these three. And so I do think they have a place in a lot of portfolios, but I just want to make that clear: is know why you're getting into an investment and think about what that investment's going to give you personally. So that's where I wrap up this video. Thank you guys for watching, and I'll see you guys in the next video.